Welcome back. Today we're ranking the top 10 Illinois cities where home prices are most at risk of crashing or sharply declining in 2026, based on real market signals such as oversupply risk, price overextension, affordability breakdowns, and weakening demand. Let's get into it. 10. Mount Vernon, Illinois. Early price weakness forecasted. Some regional forecasts project that Mount Vernon could see home prices fall by approximately -5.9% by May 2026, one of the steeper declines among Illinois cities outside major metros. When a market is projected to see significant negative price changes, it's a red flag, especially if local jobs and demand aren't keeping pace. 9. Jacksonville, Illinois. Projected price decline risk. Forecasts also show Jacksonville potentially dropping around -5.5% by mid-2026, signaling weakening demand and possible price correction pressures. Markets with slowing buyer activity, especially in smaller cities, are often hit first when affordability and economic trends soften. 8. Chicago Heights, Illinois. Overextension and crash risk signals. According to housing risk indexes, Chicago Heights has one of the highest crash risk scores in the state, around 86%, with prices well above long-term averages and historical volatility. When prices outrun local economic fundamentals by this much, even a small shift in demand can trigger a large correction. 7. Sauk Village, Illinois. Extreme crash vulnerability. Sauk Village scores at the top of risk charts, around 95% crash risk, because home values have nearly doubled relative to long-term averages and have high volatility. When a local market has seen rapid increases and historical crashes, it's more prone to repeat declines. 6. Riverdale, Illinois. High crash risk score. Riverdale also shows one of the most extreme crash risk percentages, around 95%, due to large price increases well above local economic conditions. Overextension beyond fundamental values makes markets like this vulnerable to sudden downward swings. 5. North Chicago, Illinois. Volatile price patterns. North Chicago has experienced dramatic price growth, around 94% above sustainable levels, and a history of corrections, warning signs for possible sharp pullbacks. Lakeside markets can go from boom to bust if affordability collapses and buyers back out. 4. Peoria, Illinois. Firm prices could lead to a correction. While Peoria's housing is still relatively affordable, forecasts show possible small declines mid-2026, meaning a correction could emerge if demand weakens. Even modest declines in historically steady markets can feel like a crash to local homeowners. 3. Springfield, Illinois. Affordability pressures and slumping sales. Springfield is often affordable, but slowing sales and weak demand can make prices slide if buyers step back, especially with affordability issues. When fewer homes sell but inventory stays the same or rises, prices can weaken quickly. 2. Rockford, Illinois. Mismatch between price and fundamentals. Rockford's housing prices have risen strongly in recent years, but growth may overextend relative to local incomes and jobs. Rapid price gains in affordable markets often pull in buyers early, but when affordability erodes and jobs lag, demand can cool, triggering price corrections. 1. Chicago, certain neighborhoods and suburbs. Top crash risk in 2026. Chicago's home sales dropped significantly in late 2025, especially in the city proper, with sales down nearly 11.8% in November compared to a year prior, even as prices remained high. Meanwhile, statewide data shows homes sold have declined about 9% year-over-year overall, even with prices slightly higher, a sign that demand is weakening while pricing remains elevated. Chicago tops our list not because prices are guaranteed to fall everywhere, but because demand is weakening while prices stay high, making the most expensive markets most vulnerable if buyers pull back or interest rates rise again. Why these cities could see crashes in 2026. 1. Affordability breakdown. Many Illinois cities saw price growth that significantly outpaced income and economic fundamentals since 2018, which could lead to buyers being priced out and slowing sales. 2. Sales slowing. Many areas, especially Chicago, saw home sales declining year over year in late 2025, a sign of falling buyer demand. 3. Inventory dynamic and price cuts rising. Even though inventory remains relatively low in some metros, other areas are seeing inventory tick up and more negotiated price reductions, an early indicator of weakening pricing power. 4. Overextension risk in smaller cities. Places like Sauk Village, Riverdale, and Chicago Heights show extreme overextension, meaning they have historically experienced price corrections and are priced above fundamental value levels. 5. Economic and demographic headwinds. Tight affordability, interest rate uncertainty, and uneven job growth can disproportionately hit smaller markets and make national buyers cautious. Important clarification: crash versus correction. Let's be clear, a statewide crash for all of Illinois isn't widely forecasted. In fact, some projections expect overall price growth of around 3 to 4% in 2026. But localized crashes or sharp corrections in specific cities, particularly those with overextended prices or weakening demand, are real possibilities. If this helped you understand where Illinois' housing market could face pressure in 2026, hit like, comment which city you think will be hit hardest, and subscribe for more data-backed real estate analysis.